All right. Good morning, everybody. Today is VIX options expiry. It's always the third Wednesday of the month, so you can kind of count it out. This is a lot like any other economic calendar event. Sometimes it really has impact, and then other times it doesn't. August was kind of skipped over in the broader OpEx. And September is really where everybody's piling into the options. Monday of this week was one of the lowest levels of trading participation that we've had in years. Kind of goes to the summer doldrums and the lack of participation through the summer months. So be mindful at 9:30. See what we're going to get out of all of this. Keep in mind you're likely to see a gap in the VIX depending on what platform you use. That gap is synthetic. It's because of the contract change. It's not because the VIX suddenly jumped up 4 or 5 points. Good morning. Good morning. So, looking at what we've got going on out there, Japan is up more than 1%. That's dominant throughout everything we've got going on, leading the world. Every day when I get into the office, I check the currency just to see what's going on. There's a lot of free websites. If you Google currency meter, you'll find free versions of it everywhere. Sometimes I post it in the chat. And Japan was really high up this morning. Of course, so was Europe. Beyond that, the Dow, the S&P, the Nasdaq, they're either down slightly, up slightly, hanging out around zero. We got nothing. Even the difference between the FTSE and Eurostock 50, it's minimal. So we don't have a lot. Good morning. We're going to get the minutes today. This was mentioned multiple times at various sites. If you read like the Dow Jones New York briefing or Financial Juices Europe wrap, a lot of people are looking for the minutes today to provide some insight. Now, this is where newer traders tend to get mixed up and they think that today's an FOMC day. It's not, right? We're just getting the minutes. But these minutes are still going to provide some nuanced insight. So watch the clock. 2 o'clock today, we could see a market shift. A lot of times you'll hear me say the afternoon is likely a free game for the 0-day traders. This is not one of those days. If you're trying to run a 0-day trade today, be mindful that whatever kind of market we have at 2 o'clock, it can change. So if we've been range bound all day and you're running some kind of iron condor or short vertical, you could easily get run right over. We've also got the 20-year bond auction today. It's one of my favorites. I know we probably shouldn't have favorites, but that's the way it is. I like it. You can see that the bond auction doesn't have a high impact score, but that's misleading. It's because a lot of times the bonds and the auctions for these bonds, they're not doing anything. They're just hanging out, going with the flow. You know how they say when you're dealing with people, you got to watch the quiet ones? That's exactly what we're doing here. You got to watch the quiet ones because every once in a while that 20-year will reach out and hit you like AT&T. So another reason to suspect that the afternoon today won't just be some laid back, calm afternoon where we ride into the close. Today is not the day for the afternoon 0-day traders looking to sell options. It very likely could be a directional trade day this afternoon where we are actually breaking out and running and going somewhere. And of course, that offers its own opportunities. There is a little bit of a capital rotation. If you see the money flows backing away from data centers, AI, chips, and back into more of the value stuff. Energy gained ground, healthcare, financials. The tricky part is materials and industrials right now, which is in the value space, is attached to the AI data center build out. So it's being hyped up by the growth space. So when we started to get this capital rotation, materials and industrials suffered along with them. I've been bringing this up. I want to continue to point it out because we need to keep our eye on it. We want to see if the market is pricing in a rate hike or a pause. The pause is our default right now. It's what we've been doing forever. Everybody keeps saying that they need to raise rates, but they're not doing it. And the argument is, well, it ain't broke, so don't try to fix it. And so they're just leaving it where it is. When the market had more trust in the Fed, a lot of times they didn't need to raise rates. They could just talk about raising rates, and the market would price it in, or at least begin to price it in. And that would do the job of what the rate hike was going to do. And then there wouldn't be a need to hike at all, and we'd end up not hiking. It's great. But we don't have a market like that right now. The Fed isn't trusted. The new guy is untested, and so they're kind of in a pinch. Now Jackson Hole is coming, so he's going to get a chance to state his case, so to speak. We'll see how that goes. But we can keep our eye on this and see if they're moving the curve. Right now, the first rate hike is priced into December and then further out as you go, January, March, whatever. You want to keep your eye on December to see if they unwind that hike, but also the October and September to see if they start pricing in a hike. Notice there's no talk about cuts. right? That's not happening. All right, 77,000 in the overnight at least shows that they were in here participating. They didn't sit out. They didn't really get much for their efforts. We are basically where we were last night when we opened at 6 o'clock. So the day is half done. And after 77,000 contracts traded, we got nowhere. We did finally make contact with that 3-week moving average, still riding above. We've got the 0 gamma level right underneath us, and we have transitioned cleanly through the 10 and the 3. So now we're looking to see if we can get the 3 below the 10 by tomorrow's trading session. The call wall and the put wall didn't move, so we don't have much to worry about there. And if we attempt to make a run to the upside, we've got to get through the volatility trigger that's sitting over our head. The good thing is the volatility trigger is within this week's range. So it's not like we have to break our own range to get to it. I don't know how helpful that is, but it's there. We're at a bit of a pivotal moment if you look out here on the daily. What I measured here is from this last pullback up to the all-time highs. Measured that and then sent the projection down here. The idea is answering a question about the potential for a double bottom versus an inverse cup and handle. The textbooks don't really define the difference other than when it's completed, you can look back and say, oh yeah, that was the handle. But what about when it's still forming? I'm of a mind that when it comes back and matches this low perfectly, it sets us up more for a bounce that fails, gives us a handle on that cup, and then we go lower. That's why I don't call those a double bottom. If we match the previous low perfectly, my expectation is that it's not a double bottom, that it's actually an inverse cup, and that we might get a handle, we might not, but that it's likely going to continue lower. But when we overshoot, when we cross that perfect low and we go lower than that, I start considering it as a double bottom. Double bottoms, double tops, those are traps. So a double bottom is a bear trap. You can't trap a critter if the critter doesn't get into the trap, right? You got a bear trap, beaver trap, whatever. How you going to get it if it doesn't get in there? So the double bottom is a bear trap. You have to get some bears in. They have to get below the last low so that they can get in there, begin to participate. Once we're through that low, we need to see that they're getting in. We need enough of them in there that when we start to trigger it and buy, those bears are forced to buy as well, and then they add to the buying pressure, and we get this strong reversal back in the other direction. So what we don't want to see is price lingering down here another day after another day after another day. We want a very sharp, solid, clear reversal showing that we trapped those bears, squeezed them till their heads popped, and forced them to buy to close, which adds to the buying pressure and validates the pattern of the signal. Now, I've got the fib lines on here with the 111 and the 1236 because it lines us up on how far below the previous low we should go and not travel too far. We hit the 111 yesterday perfectly. Now we're dealing with the extension down into 1236 with this wicking this morning. And so far, we're working our way back up. I would have liked a bit of a deeper wick down here, but I mean, it's not that we need it. So at this point, we want to watch to see if we're going to linger down here within this candle that we've just created, or if we're going to begin the push. If the bear trap worked and they spring it with buying, we should see the bears add to that buying, and we should be able to break yesterday's mid and then challenge yesterday's high, which gets us through the 10, the 3, the 786, everything that's over our head, and have us focused on the halfback up here, 77.82. But if they don't activate the buying, or the buying doesn't activate the bears, and we end up holding out below this 100 level, then the trap failed. And we're going to continue down here, and we'll have to see how that plays out. It might set up into a failed flag pattern, or we could break down and continue lower. Right now, it's just the setup for a double bottom. We need the other side of it. This is the expected range for the day. The average daily range right now is 82 points. So from the Globex open, we can move 41 points up, 41 points down, and the distance between these two red lines is that 82 points. If we get bullish today, we can reach up to the yellow line up here, and if we get bearish, we can reach the yellow line down here. So the upside move 77.55 and 7,800, basically, if we just want to round that up. And to the downside, 76.73 and 76.32 cog line. Now we can add to that. If we want to break down, we got to get through our own Globex low, 7,700. And if we want to break out or reach the upper ADR, we got to get out of our own Globex range, 77.22. We broke out of yesterday's range, so we had an inside day breakout, but we wasn't able to keep it. We did it twice, got lower lows each time, and we still didn't keep it. Now we're setting higher highs and higher lows. So we've begun the reversal to walk it back up. But if you look at it on a higher time frame, it's been a significant drop. We don't know yet that we're getting a reversal that's going to run us back up. And it's very likely we're just going to hang out down here and try to digest this move that we made. Yesterday's RTH high, 77.32 cog line, then the ADR half. All of yesterday marked the high 77.70 and then 7,800. So we got some decent levels. I don't think it's going to help us, but could put a mid on there. Yeah, it's not helpful. Maybe the mid here. Now we've already hit that. I'll mark it so you can see it. The RTH is what I just measured here. RTH low, RTH high. See the midpoint. It's basically what we're already fighting with. So our Globex high is the mid of yesterday's RTH session. RTH means regular trading hours. All right, today's floor pivot is lower than yesterday's. This is yesterday. This is today. It's lower. That's bearish. Price opened underneath it. That's also bearish. So far, we haven't hit it. So it's a possible MDP. But yesterday, we did not hit it. And that is an MDP. MDP. Missed daily pivot. We can't count it as an MDP today because we don't know if at some point we might run up and hit it and then it wouldn't be missed anymore. But we do have one from yesterday, and one of them by themselves isn't much. But when you start to get consecutive, again and again, back-to-back days of missed daily pivots, then it becomes more powerful as a signal. Generically speaking, we tend to stay within the boundaries of our regular movement, right? Watch somebody walk, and they tend to walk the same way unless they step on a Lego barefoot or something, right? Their movement doesn't change unless something causes them to change. Well, that's price when it's moving. So when it's bullish, we get day after day runs to the upside. As long as we can keep that strength going, it won't fade back enough, even on these days where we had downside wicks. It won't fade down and hit the daily pivot, and we'll get missed pivots. That kind of helps us validate the strength of the move. But it happens the other way around too. So we start getting day after day moves to the downside. We want to see if we can get the same thing. We got one yesterday. We want to see if we can get another one today. It won't count until tomorrow. And if you want to know more about it, there's a guy on YouTube that really highlights this concept. He uses it from a swing trader's perspective. Now, I don't trade the strategy either way as a day trader or a swing trader, but I didn't learn the strategy to trade it. I learned the strategy because it's useful in analysis, which is why I learn a lot of strategies. So if you want to know more about it, you can check on YouTube. It's called Missed Daily Pivots. I think the guy did a really good job. I can't remember his name. I'm horrible at names, but you can't miss it because he's done more than one video, right? We also continued our move away from this weekly pivot, 77.92. And we need to worry about how far away we are from that weekly pivot. It's like stretching a rubber band. If you take a brand new rubber band out of the box and you just stretch it as hard as you can, you're likely going to break it. You take a rubber band out of the box and you keep stretching it a little further every time, easing it into the stretch. You can stretch them out pretty good. That's price when it comes to these levels, like a floor pivot or how far from the 10 we are, how far from VWAP we can get. It's the same logic. If we just run away from that floor pivot, we won't get too far before we'll end up with some mean reversion. We'll bounce back the other way. But if we get week after week after week, stretching how far we get away from that pivot, we can get a lot farther every week. We haven't had a downside week where we've gone 4.5%, 5%, 6% away from this pivot. This is basically the first stretch. So 3.5% to 4% is likely about as much as we can handle before we start to see some serious mean reversion. And if we did that, say Monday afternoon or Tuesday, really early in the week, it would give us time to stretch again. And by Friday, we could get to like 5.5%, 6%. But it's Wednesday. The week is half done. Today is half done. And we're running out of time to get a 4.5%, 5%, 6% move away from that weekly pivot unless we get really bad news. Right now, we are not even 1.5% away. So this might feel like we've had a bad week, that the market is all bared up and everything's going down and it's really bad, but we haven't done much of anything this week. We're not oversold. We haven't moved too far too fast. And at this point, it doesn't owe us anything. Certainly not a move back up just because. The path of least resistance today is to the downside. What I'm looking at here is the daily floor pivot and this S1 level versus the daily floor pivot and this R1 level. We can see that R1 is closer than S1. S1's a lot farther away. So the path of least resistance is to the downside. That does not mean we're going to go down. Doesn't mean we have to go down or that we should go down. It just says that it's easier for price to move down than up. We made a run towards S1 and we abandoned that run. We had an inside day breakout twice that we wasn't able to keep, and we've already started working our way back towards the daily pivot, and we've checked the channel on that pivot. It's very likely that the run down into this S1 is done, unless something that we get in the news this morning turns us around and gives us a reason to head back in that direction. The cumulative volume index shows that they lightened their portfolio a little bit, but they didn't dump it. This isn't panic selling or, a flight to safety. They just eased up. And considering the allocation levels that they're holding, sitting at all-time highs, it makes sense that they want to lighten their load a little bit when this breakout stalled. So we're resting at the 10. That's not really a big deal. The Bollinger hasn't started to curl inward, so it's not losing its volatility. Everything looks fine at this point. I'm kind of impressed, really. We talked earlier this week about how if we broke this value area low, there's nothing back here to help us out. So this pause or this reversal that we got didn't come from trade structure, from any old footprints or anything like that. There's some moving averages down here and some measured moves and all of that, right? There's certainly pivots that we bounced off of, but we didn't get any help from old volume footprints or the profiles or anything like that. It does, Jay. I think you're right. If we try to make a run back up, like I've discussed earlier this week, we're going to very likely have a problem around that 77, 75 area. We got the distribution from this week and that week, and a little bit from our own current week, right? So that's 2.5 weeks of distribution up there. I think we're going to have a hard time when we do finally make a run at it. But at the moment, our bigger problem is our current week's point of control, which is what we're struggling with down here right now. So we're putting in a lot of work throughout the day today. I won't be surprised if we shift this value area high line and bring it down closer to that 77.40. That'll give us a much narrower value area, help build out our distribution structure a little better. And it could give us a possible breakout point, that and the 77.50, to try to retest or reclaim those levels. I keep looking for what the catalyst is going to be to give us this upside drive, and I got nothing for this week that could do that. It's not the fact that we have OpEx looming, because I mean everywhere we look it shows that there's the amount of expiring options is negligible compared to what we've seen recently. It's next month's options that have a bigger catalyst, and next month, of course, we got the new FOMC, and there's been talk that other nations are going to start hiking. Of course, there's been talk that we're going to hike, and like we already discussed, that doesn't seem feasible at this point. So what's going to drive us this week and get us to break this range to the upside? I don't see it. Spot Gamma doesn't see it. It's likely we don't get anything. $10-day, 30-minute volume profile and TPO. A run to the upside is going to have to deal with this point of control, 77.72. I already gave that number today from the 5-minute active chart. So now it's a double layered level. It's going to be difficult to get through if we did make a run for it. It doesn't quite line up if we look for a half of this run, but still, if we do make a run to the upside, 77.42, which is a old school cog line we don't use anymore, 77.50, and then 77.72. It's just a big distribution, right? It's a big ugly mess. We're building out some down here at this zone. Then of course the point of control, a little speed bump there, and then this area up top. We're going to lose that first, right? Kind of take that off the table. By Monday, we should be done with a lot of this volume down here. We have to see, what new work we put in this week, but I would expect that that's going to diminish considerably. So it'll start to clean up a little bit by Monday. It's not a surprise that the path of least resistance right now is to the downside with all that trash over our head. We have a new VPOC from yesterday. If we look at this distribution, this is a classic B-shape distribution. It's a really good one. Might be worth saving that. He's so purty. So now we've got two VPOCs over our head. Basically 7,800 and 7,724. If we make any attempt to run to the upside today, breaking our own Globex high, we're going to tangle right up into that VPOC level. The thing is, though, I wouldn't get too hung up on exactly where it sits. If you look at this distribution, it's really big, right? This whole zone here. And that's a lot to deal with. Plus, just putting it into some context, the bigger zone, all of this, it was just us sitting there all day yesterday building it out, right? A trash, nasty day that didn't warrant any of my attention. So if we want to make a move to the upside, we're going to have to get through all that junk. So far this morning, we've got a really nice classic D-shape distribution. We'll see if that plays out, but not expecting to keep that. And we are at the edge of the weekly expected move. So, of course, we broke this low pivot, as we talked about earlier. We've reached the edge of the expected move. Now we got to figure out what we're going to do with it. Keep in mind, there's a 70% chance that we close inside this box on Friday afternoon. But this is Wednesday. Between now and then, we could continue the move to the downside and then rally back up. We could just hold the line here and not get any deeper. And of course, there's plenty of weeks where we actually close outside the box. Statistically, we're more likely to close inside of it than outside of it, especially since we had a breach recently, 2 weeks ago, right? We had that breach. If this was like week 6, where we didn't close outside of the week and we have been doing it again and again and again, staying in the lines, I'd be more willing to think that we could get a breakout that sticks. But since we had one recently, it kind of takes away from the idea that we're due to have one now. So we need to let it play out, but keep your eye on the weekly low. See if we can maintain our presence in the box or if we lose it and break out of it. Keep in mind, these levels are not arbitrary, right? It's not random. And there's billions and billions of dollars spent at the edges of the weekly expected move in the S&P. That's what makes it so valuable, right? Long ago, the guy who decided that we should be watching these levels laid out this argument on them. If you don't know what we're looking at, come on, Thinkorswim, you can do it. There's an implied volatility attached to the options side of things. just use the SPX here for a minute. So every Friday, we can come in and we can look at what the expiration expected move model is. And we look at it the Friday before, right? Just like every Friday, we do it in the briefing. Now, what a lot of traders do is they focus on today's levels. They look at, August 19 and take it across and they say, hey, we got a $28 expected move today. We can move up $28, we could move down $28, and that's our range for the day. That's our expected move model for today. And there's nothing wrong with that. I don't have a problem with it. But there's also a bigger level, the Friday level. The intraday one is going to change. So if you're looking at this August 19th level, it's $28.50. 2 hours from now, it's probably going to be $26. By noon, it's going to be $12. It's going to continue to move and adapt. It'll shrink as we run out of time. And by the end of the day, it'll be to zero. But it's not the only one moving. All of these numbers are moving. It's a dynamic model. It's constantly updating and moving, but we're using a static level. Our levels don't move. We look at where they are on Friday when we go into the close, and they get locked into place. We draw the lines, and then that's it. We don't move them. The reason for that is there's firms who are trading that expected move on one side or the other. Maybe they're bearish and they're selling a boatload of calls on the green line, or they're bullish and they're selling a boatload of puts on the red line. Either way, there's a massive amount of money that gets developed on these levels. That's why these levels become what they are, right? They're in there trading out a lot of options at that spot, and then it changes the implied volatility by the time we go into the close on that Friday and we get our lines for that week. So if we break that zone and we begin to expand to the downside, all the money that was in there, they're going to have to do something with it. Now, if they're short calls, they don't care, right? They're just going to roll those calls down, make more money, and enjoy the breakout. But if they're short puts and we break that low, they're going to need to defend those puts. And that can create a volatility loop, and then we can really get some drama. Kind of what it looked like here when we broke out to the upside, and it forced the next day to really expand. Now, that wasn't just because we broke out of this range, right? There's a lot of reasons we had that day, but that didn't help the cause. So weekly expected move model, we're on the edge of the week. You can go in and examine the SPX lower edge and look at all the options that were built there and see if it's larger than the upper edge. Try to see if, were they running callers? Did they just run one side or the other? Where did they put their money? It'll help you better understand what they're going to do if we break that low today in the regular trading session. It's a bit early for that kind of nerd talk. All right, we're below the 10-day again, like we were yesterday, but not deep. This isn't dangerous. It's not bad yet. We're kind of in a good spot, hanging out near the 10, above or below. Not necessarily a bad thing. It's kind of like being in the center of the basketball court. From here, we could move 2% in either direction. And that 2% wouldn't be overbought or oversold or anything like that. So this is a good spot to be. It's like being in the center of a storm. It's the calm spot. You'll see the flows are different in the SPX. If you look at the options that are being traded, the size of the trades that come in, how fast, the pace of the tape, it's all different when we're this close to the 10, like a 0.5% above or a 0.5% below. The dynamics are just easier, calmer. So as long as we're sitting inside of this range, it's likely we're not going to see increased volatility or an expansion day, and we should get the kind of days that we had last week, these smaller mid-range days where we really didn't do much. On the week, we're still more than 1.5% above the 10 week. It's not a bad place to be. We are continuing the fade away from that 3.5 level that we had. Still, we're not overbought, we're not overextended, we're certainly not oversold. We're just moving our way back nice and easy towards that 10 week. And this is a healthy place to be. So we're not broken. Looking at what's down this morning, Bitcoin is down, but not by much and not enough to meet our needs there. Robots is down. That's not necessarily a good thing. We use that one for risk on, risk off parameters. It doesn't bode well that they're getting out of the riskier stuff that they're not willing to stomach or tolerate the riskier things. But there's not a lot that's down. There's a whole lot that isn't up or down enough to even meet our qualifications. And then when we look at what is up this morning, gold, gold miners, junior miners, a little bit of China, and some energy. This isn't what rallies a market. If we're going to get some sort of market breadth and dealer positioning that comes in and really lights our fire, we're going to need more than this. I was kind of looking around a little earlier, just searching for some depth to the breadth out there, and yeah, there's not much out there. You see, it's a lot of consumer services and non-discretionary and value over growth, right? It's not really all that helpful if we're looking for the fuel. All right, let's wrap it up and get this day going. GTFO, right? You got to get out of the box if you want to get anything else done. Now, I had somebody ask me yesterday, how do I know if today's going to be a good day to trade? Well, good for who, right? Some people want a sideways day where we don't do anything so they can sell options on it. Yesterday would have been a good day for that, right? A sideways day, we didn't do anything. If you're selling premium my way, that'd have been a good day to do it. But if you're trying to trade directional, you think we're going up, you think we're going down, then put a box around the Globex. It really is this simple. Put a box around the Globex. If we stay inside this box, that's your home. You want to trade direction? Then you need to be able to make money from the bottom of this to the top of that. And then you need to be so good that you can nail it from top to bottom. Are you that good? If it's a 20-point range and you can pimp it from the top to the bottom, then you can get those 20 points. Otherwise, be realistic. Maybe you can get 5 points in this 20-point range if you can catch it somewhere in the middle. But if it looks like yesterday, then it's trash and you probably shouldn't be trading it anyways. So if you want to trade direction, get out of this box. Then you have the possibility that we're actually going to go somewhere. Set an alert at the high and trade something else, or at least go watch something else. If we break through the high, then you can at least target yesterday's high, either the RTH or the mid or the full. You got up